Good, welcome now to adult accounting. We're going to start really with adult accounting today. And with that, we're going to do IAS1 presentation of financial statements. Now you're going to see that you're going to have a number of videos on IAS1. I've broken it down in small little bits and pieces because I think in total there's something like 60 slides, which in totality I will upload on Ifundi. Now, IAS1 links very closely to the conceptual framework. The conceptual framework is not an IAS, it's not an international financial accounting statement. It is only the foundation on which all the international accounting standards and statements are actually based on. So therefore, it is very important that you understand and know the principles which was laid down in the conceptual framework. It is also very important that you go and have and revise the definitions and the recognition criteria of all the elements of financial statements which we have identified in the first semester, because there's such a close link between the conceptual framework and IAS1 that I can ask you those definitions in the second semester as well, because it links very nicely to the principles set down in IAS1. So let's see what IAS1 is then all about. What is the learning outcomes? Now, to apply knowledge of IAS1 in a given situation by, amongst others, identify the elements of financial statements and other basic concepts in a situation. Coming back to what I've just said to you, here we're going back to the elements of financial statements. And that is why I'm saying you have to know what are the elements: assets, liabilities, income, expenditure. You have to know the definitions of those elements, and you have to know the recognition criteria of those elements, because if you don't know that, you cannot do IAS1 and you will definitely be left out in the cold. The second thing is you must be able to do recommendations on the recording or the disclosure of transactions. Guys, we are busy training you as chartered accountants or forensic accountants. For sure, and definitely not as bookkeepers. A bookkeeper is something that the computers has already taken over. It's not even something that's going to happen in the future. It has already happened. So a bookkeeper, you do not want to be, because there's no work opportunities for you as a bookkeeper, and it is extremely boring, very boring. But you have to know the basics of how to record a transaction, how to process a transaction. What must I do in order to get a certain outcome? What must I do in order to adhere to all the international accounting financial standards to record a transaction? So you have to have the technical knowledge, number one, to see whether the transactions has been recorded correctly. If it hasn't been recorded correctly, you can make definitely the wrong decisions based on that information. If it's not recorded correctly, obviously you are going to make the wrong recommendations, because the information that you're using in order to do the recommendations is totally unreliable. Now, that is what we aim to do with you. We aim to give you the technical knowledge in all the phases, year 1, year 2, year 3. But then obviously when you get to CTA or honours, then we are not focusing so much on the processing of the technical stuff. We will give you very often what has been processed, and then we ask you to criticize that, or to give recommendations, or to ask you whether it actually adheres to the requirements of the statements. So disclosure is also very important. Why is disclosure so important? If I do not disclose my information, my financial information, the way that it's set out in all the different statements, then again, I'm going to interpret the financial information incorrectly, And then based on that, I'm going to make the wrong recommendations and the wrong decisions. So it is extremely important that you understand what is the technical stuff behind the recording of the transaction. You must be able to interpret whether financial information is correct, in other words, whether the transactions has been processed correctly. And then based on that, and that is where the focus is, you have to look forward and you have to make certain recommendations or decisions. So, accounting is not something that wanders around in the past. We are merely using those information that was gathered based on historical information or historical transactions that took place, and we're going to use that in order to project that somewhere in the future. So therefore, it is of extreme importance that our financial statements are reliable. Now, you cannot make a recommendation without motivating why you make the recommendation. And you can't motivate yourself if you do not have a sound knowledge of what is the topic on which you're going to give the recommendation. And if you do not know the information and you do not know the technical requirements surrounding that type of transaction, then you will not be able to fulfill your job. And then the nice thing is that all of us, I have never in my life met a decent accountant which does not like to criticize. We have to criticize the disclosure in a given situation. And it's not always bad criticism. It can also be good criticism. It can be excellent. It can be 100% on the dot, or it can be totally wrong and a disaster. So, but you can only criticize if you know what is the right alternative, which should have been presented instead of the one in front of you. Right, then we have to compile the following components of the financial statements of the company according to the minimum requirements of the Companies Act and IFRS. Now, we have, in a conceptual framework, we have identified the different elements of financial statements. Now, what are we going to do with those elements? It's not good enough to say, yeah, well, that's an asset, a liability, income, expense. What are we going to do? Where are we going to show that? How are we going to deal with that? And if I cannot answer those questions, remember, I must present the financial statements in such a way that any person with a reasonable accounting knowledge will be able to read it, to interpret it, and to make decisions based on it. So therefore, I must be 100% sure that how I'm going to package this deal of components, that it makes sense to the readers of the financial statements. You will see that we have to adhere to the Companies Act and IFRS. The Companies Act, though, refers to IFRS, and by implication it says once a company is compliant with international financial reporting standards, it will also mean that they are compliant with the Companies Act. Now, our first statement, and you are very familiar with that one, is our statement of financial position. There it is. Now, what do we record in our statement of financial position? That is the financial wealth of the entity. What is the assets, liabilities, and equity position of that entity as at a certain date? So usually we compile that at financial year end, and we say, well, at that specific date, let's say it's 31 December. At 31 December 2020, we had so much assets, we had so much liabilities. That meant that our net equity was so much. So if our equity keeps on increasing, it's positive. It means what impacts equity? Our share capital, our profits for the year, and our distributions to the owners. So if that is a figure that actually keeps on growing on an annual basis, it means, I think the assumption can be that this entity is actually doing fairly well. The second one you're also familiar with, especially the first part. The second part you're not familiar with at all. The statement of profit or loss. And in the statement of profit or loss, we are measuring the financial results of this entity over the financial period that we're looking at. So usually it's a 12-month period, starting at the beginning of the financial year, ending at the end of the financial year. And what do we measure there? We want to see how successful did management apply the resources to their disposal in order to optimize those resources to generate profits for the entity. If you are not in the game of making a profit, then you must do something else. Go and play golf or something like that. But you have to be in the game of making money, profits, if you are conducting a business. So that is what we measure in the statement of profit or loss. Now you'll see that there's a little tail that has been added to that, and other comprehensive income. Now, other comprehensive income is not income generated by the normal day-to-day transactions. Now, we have come across one of those items that we record there, and that is when there's a revaluation surplus, when we revalue a non-current asset like property. Let's say, for instance, we bought the property initially at 2 million rand. It is now worth 3 million rand. Now we decided we're going to apply the revaluation methodology based on our property. So we're going to increase the value of the property with R1 million, and then the counter leg, the credit leg, that is going to go to the revaluation reserve via this line item, other comprehensive income. Right, so then the third one, and that is a new one for you, is the statement of changes in equity. Now, what is equity, we said? Equity is share capital, equity is profits, equity is distribution of profits to the owners. Now, equity being share capital in the case of a company. So, equity being share capital, not normal capital like in a sole proprietor. Equity, and that shares can be issued, have an opening balance. I can issue more shares in the current year, so that would be a movement for the year. I can buy back some of my shares, that would be a movement for the year. I can convert some of my shares, that will be a movement for the year. So all the share transactions that took place in the current financial period, that will be accounted for in the statement of changes in equity. Profit, where is our net profit? Our net profit, we calculate in the statement of profit or loss. Now, in a one-man or sole proprietor type of business, what do we do with the profit? We transfer the profit to the owner. Same thing with companies. What do we do with this profit that we're actually going to calculate in our statement of profit or loss? We are going to transfer that to the owners. Who's the owners? The equity holders. So that net profit that we're going to get in our statement of profit or loss and other comprehensive income, that is going to be transferred to our statement of changes in equity. In a sole proprietor, we also accounted for drawings under the equity section. Now, the same thing applies to the companies. The only difference is that they cannot make any drawings, but the distribution that the company make to their shareholders, i.e. dividends, that is a portion of the profits that the company has made that specific financial period that they distribute to the owners of that company. We call that dividends. Now, that dividends, that will also appear then in the statement of changes in equity. So for sure, when we get to company transactions in the next study unit, you are going to come across a statement of changes in equity, and they will be expected from you to actually do a statement of changes in equity, understand it, and be able to interpret that statement of changes in equity. Now, yes, statements, and we have seen up till now that we do not want to make that statement so big and with so much detail included that you lose track of what is actually that statement tries to tell you. Now, for that purpose, we have invented explanatory notes to the statements of all our financial statements. All of them are accompanied with explanatory notes. Now, what is the most important note of them all? That is my accounting policy note. Why? Well, that is very simple. if I am going to look at a company's results, and especially if I want to compare similar type of companies with each other, the first thing that I need to know is what are their accounting policies. We have done inventory by now. And you know, when we've done inventory and we've done inventory valuation based on first in, first out, or we've done the inventory valuation based on the weighted average method, that we get different answers. And that answer goes through to our income statement. So it's going to affect our profits for the year. And it will also affect the value of our asset, which inventory, which is reflected in the statement of financial position. So if I have two identical companies, the only thing that differs between the two is their accounting policy, let's say on inventory valuation. And I compare the two with each other. I need to know that the reason for the difference in their performance as well as in their asset value at the end of the year is actually being brought about by the different accounting policies that they apply. So if I know that, I can make certain adjustment entries on the sideline in order to put them exactly on the same level so that I can compare the results with each other. So accounting policy notes that you have come across, the first one that we will say is on what basis do we prepare our statements, our financial statements. Is it historical cost basis? In your case, it will always be historical cost basis, but it's going to change from next year onwards. The only exception that you will have in this year could be if I decided to revalue my non-current assets. So that would be a deviation from the historical cost principle, and you will state it as such, that you are applying the historical cost base, you are preparing your financial statements by using the historical cost principle, except for non-current assets, land and buildings, where the revaluation method is applied. So I need to show that for the reader. I need to put it down specifically. Well, other explanatory notes, well, if you think of the IAS 16 note, the property, plant and equipment note, we only have a one-line item in the statement of financial position, property, plant and equipment. But we have that long note, start off with the carrying value split between cost and accumulated depreciation at the beginning of the year. We do all the movements in the year, and we close off with the cost and accumulated depreciation and carrying value at the end of the year. So that is fairly explanatory itself. It gives you much more information. If I have property, I even have to disclose exactly where that property is situated. So a lot of detailed information, but not in the statement of financial position as part of the notes to the statement of financial position. So you've done a trade and other receivables, where you show them the trade debtors, you show them less allowance for credit losses, less allowance for settlement discount. Then you had your net trade debtors, and you added things like prepaid expenses, deposits, all those kind of things in order to derive at the final figure, and only the final figure for trade and other receivables is reflected in my statement of financial position. Very important, so that the reader can actually see what does those figures consist of, and that will enable him to make comparisons between this year, last year, years before for the same company, or between companies which is similar in nature. And then our last one is our cash flow statement. Now IAS 1 refers to the IAS 1 to the cash flow statement because it is part of our financial statements, but then there's a separate statement that they brought out which is only about the cash flow statement, and that is IAS 7. And after we've done companies and companies transactions, we are going to do IAS 7 and the cash flow statement, in particular for companies. Now, with fair value accounting, which you are really going to start working with next year onwards, and now, like we said, it's only the property that we can revalue, that we're going to use the fair value principle. But you can see that if I show quite a lot of my items at fair values in my statement of financial position, there's a little bit of subjectivity that creeps into my statement of financial position. Now, for that reason, it must still be a fair reflection, blah, 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 but you will see it is not cast in stone. It is based on a lot of assumptions, and a lot of those assumptions is if in the future this, in this, in this, in this is going to happen or not happen. But in my cash flow statement, if I have 100 Rand in the bank, I have 100 Rand in the bank. There's no subjectivity around that. If I have nothing in the bank, I have nothing in the bank. No subjectivity around that. So as far as I'm concerned, cash is king. And the cash flow statement, as far as I'm concerned, is the most important financial statement that you can use in order to make decisions. Why? Because there's no bamboozling there. I had X amount of money, I had 100 Rand in the bank. I bought 50 Rand worth of inventory. How much do I have in the bank? 50 Rand left. I can do whatever I want. I cannot make it more, I cannot make it less. That is a fact. There's only 50 Rand in the bank. Now, if you look at the other side of the story, the inventory, 50 Rand. Now, we've done inventory, and you know that inventory can start playing around. There could be a net realizable value adjustment, and that can mean that we're going to show that inventory in our books at 40 Rand and not 50 Rand. What is NRV? NRV is based on the future expected sales proceeds less any compulsory selling costs. Am I sure I'm going to get that? Is that cast in stone? No, it's based on predictions. So suddenly what happens to my inventory figure? There's a little bit of subjectivity in my inventory figure. Is there any subjectivity in my bank figure? None whatsoever. So in the cash flow statement, it's about cash in and cash out, and no fancy accounting footwork. Wonderful stuff. Good. Now, if you are an accountant, let's see what it looks like to the outside world. Your friends think you are using a calculator the whole day, sitting and adding and subtracting, and they think you're a bookkeeper. Your parents think that you are extremely important. My son, my son, my son, my son is so great. Society out there, what do they think? Guys, a lot of you started to think that chartered accountancy or forensic accountancy is great. Why? Not because you had a passion for accounting, because you've heard somewhere in the grapevine that accountants make a lot of money. Now, I've got a news for you. We do not do that bad, but it's not every accountant who becomes an Anton Rupert or a Harry Oppenheimer or one of those guys who actually makes a lot of money. No, most of us is making a living, but we are not in the position to sit back in our chairs every day with a big smile on the face and counting our dollars every day and think that we are great. So if you think just by being an accountant you are made, it takes much more than a CA in order to make you this man who can sit down with a big smile on his face and counting the dollars. Your boss thinks you're busy with games that kiddies are playing and keeping themselves busy with. So he doesn't think that much of you. You think you're Einstein. Yeah, or maybe a little bit more than Einstein. You're great. You are really acing it. You think you are the greatest thing since the invention of the wheel. But in actual fact, what happens every now and then when you sit in front of your computer or your tablet and you're doing accounting, you are screaming with frustration because this subject is going to drive you crazy before you're going to finish off your studies. So this is really driving you around the bend. And sometimes you think, what devil has come into me to become an accountant? Then I'm going to continue with the rest of the thing in the next video where we're going to continue with IAS.